Okay, so we are off to a positive start. As quickly as I said that, the TSX moved into negative territory, but the mood in May ended on a positive note, that's for sure, with the Canadian stock market enjoying a sixth advance in the past 7 months. The S&Ps had similar stats over, call it, the last half dozen months. And let's get a sense on where the money could be flowing going forward if some of that momentum continues. Brian Bendig is Chief Investment Officer at MJP Wealth Advisors. Brian, it's nice to see you. First of all, on the markets themselves, do you see more momentum ahead?
Good morning, John. Great to see you as well. Yes, I mean, I think the market, and we are also positive on equities over the second half of the year, assuming earnings outlooks continue to hold. I think that's really the story on this first half of the year, is that earnings have, we just recently completed about, we have 10 companies left to report. More than 90% of the S&P reported, and those earnings came in better than expected. And we're also seeing a broadening of earnings, outside of areas than just tech. And I think that's a good news item for the markets. We're in this quiet period right now, I would say, where we're going to be focusing on inflation reports, jobs reports, some of those, key macroeconomic indicators until we get to July earnings season again. But, second half of the year, if earnings continues to hold, I think it's possible that this market can continue to grind higher.
I know there's a lot of focus on tech, certainly is once again today with the AI chip leaders, NVIDIA and AMD, their bosses championing what looks like a lot of appetite for their products for the foreseeable future. But there are some trends in the market that were notable in May. Bloomberg Intelligence was talking about how value seemed to be finding its groove during the month. As a classification of stocks, value is an area that you've been watching very closely. Can you elaborate on what you've been seeing in the market?
Absolutely, John. I think that's a great point because, right now when we think about where to invest, we believe in that longer term trend regarding AI innovation and some of the productivity benefits that could lean it, that the markets and society and the economy can lean in on. So it's not surprising to hear those comments coming from, some of those semiconductor and other large mega cap tech names. So that cycle is still going to take, 5 to 7 years to play out. But in the short term, we really saw last year with 72% of stocks underperforming the market and really being left behind. That value trade, looking at healthcare, industrial, medium-sized companies, even smaller companies, valuations look attractive. So outside of earnings, the one thing that we're trying to caution and highlight to investors on is focus on price. Look at that price to that earnings ratio moving forward as a classic indicator of valuations, because as earnings continues to expand, and we're expecting and seeing in these earnings outlooks, John, over the balance of the year, that you're going to see a wider range of contribution in profits coming from areas outside of tech. And if that plays out, that's going to help to support concerns about the market being overvalued, because in these other areas of the market, no pun intended, value has a chance to participate.
And what would be the caveat, I guess, in a time where, generally speaking, people are finding a lot of reasons to stay invested? Are there any things to be mindful of outside of what you were just talking about with maybe some of those stocks that have had somewhat stretched valuations?
Yeah, definitely. That's a great point. I mean, there's always risk, of course, on the other side of making this longer term investment. So the things that we have to stay concerned about is, number one, are we going to still, dance through the raindrops, so to speak, here between an economy that we're expecting to slow over the second half of the year due to slower consumer spending, but still being positive for growth, while the Fed is dangling the uncertainty around when the timing of rate cuts are going to occur to kind of support the economy, but also get back to normalization as inflation's coming down. So I think the biggest risk in the second half of the year is if you have an economy that contracts more than investors are expecting, you have a labor market that shows weakness more than investors are expected, and then at the end of the day, inflation does not continue to come down on a sequential basis. Obviously, we're in the camp that we think inflation will continue to decline over the course of the year. We will still expect Fed rate cuts sometime between September and December. And I think as long as earnings hold true, that's, again, why we're still constructive on multiple areas of the equity market.
Before I let you go, here in Canada, we've had a nice roll for the stock market. We'll be talking about that very issue of interest rates this week because we got a Bank of Canada interest rate decision. But this is a market where there's a lot of exposure to financials. The banking sector and the makeup of that group obviously has differences than the U.S. market. But you've also got a lot of commodities exposure here, areas like energy and metals as well. A lot of people have been watching copper. A lot of people have been watching gold. Within those groups, how do you feel about the outlook from here?
Yeah, I think as long as aggregate demand is still there, John, I mean, I still think that this need for raw materials still is going to play out on a multi-year perspective. I mean, I think, every country, not just focusing on US versus Canada, but there is a renewed focus on improving the electric grid for most countries. And some of this innovation that we're talking about does require a lot of instrumentation supported by copper and other types of raw materials. And as it relates to gold, I mean, I think that's really more of a trade from the standpoint of, concerns and fears that sometimes exist with certain events around the world, but also paired with, are you going to see declines in the value of currencies that also will help to support commodity prices? So again, as we think about things through the balance of this year into early next year, a little weakening on some currencies, you might see some appreciation of commodity prices.
Okay.